Hey, it's Greg with the Gale team. It's Monday the 16th. I wanted to send this update out because I'm getting an influx of questions about the Fed meeting yesterday, about dropping the Fed funds rate to 0%. And no, that doesn't mean that the interest rate of a 30-year mortgage went to 0%. It's the rate that the banks lend to each other. I mean, literally, cash has no value for them right now. They're just moving money around. And a couple other changes have happened. First of all, we got to think there was a meeting set for Tuesday, tomorrow. And instead, they said, hey, this is so important with all the stuff going on with COVID-19 and what's happening in the global economy, that in the United States, these are the things that we need to do to continue to lessen the bleed of our economy and maybe spur a little bit of it to last during this COVID-19 outbreak and what's happening with closing of businesses, government shutdown, states of emergency. We need to be making these certain moves in the economy to keep it all going. So they took it from, hey, let's meet on Tuesday to, hey, we're meeting Sunday, and we're now going to cut that to 0%. Now, there was some other stuff in there, and actually I have some notes here that I'll go through, but you know, on the 3rd, so almost 2 weeks ago, the Fed met and said, hey, we're gonna cut the Fed funds rate. And in the short term, that will have some impact into the mortgage back securities. So if typically if stocks go down, so stocks go down, then people take their money from the stock market, they move it into the bond market, and that lifts the bond market. Well, the bonds are the mortgage back securities. So this is MBS, mortgage back securities. They get healthier. That means the rates go down. Well, last week we started seeing people pulling out of the stock market and the bond market at the same time. So this is where that emergency came and said, hey, what can we do? And I mean, these guys are super, super smart. I mean, they're making decisions in these world economists on what's going to happen with the global economy and then right down into the US economy. So by taking this, they've also taken $700 billion and allocated it into our economy, into the funds. And what they're going to do is 500 billion is going to be to treasuries and 200 directly into mortgage-backed securities. And this morning they used 40 billion to infuse directly into the market today. So 40 of the 200. So once again, you got 700, which is 200 and 500, and of the 200, 40 was just used today. Can't see that, can you? So 700 is 500 treasuries, 200 to mortgage-backed securities. 40 of it was used this morning, and we did see the rates stabilize a little bit. They didn't get like hugely better. They didn't drop a ton. They just stabilized. Now, why? Well, you got a couple different things here. We still have all this volatility in the stock market, and you have an influx of business over the last 3 or 4 weeks into the mortgage business, where last week for the first time, I went online to look at what rates were from other banks, and they were at like 5 and some at 6% because the banks cannot handle the business. Typically, there's about $1.5 trillion in loans going in the country that the mortgage system can even handle, that our industry can hold. And they're saying there's upwards of 3 to 4 trillion going right now, with the ability, and I should say there's a benefit to upwards of 10 trillion people, 10 trillion to do a mortgage, right? To benefit. You got the home buyers that are saying, hey, these rates are great, let me go buy. But you have all these people that have the ability to refinance. That's if they're still have credit, still have the jobs, that still have the income to qualify. But if they're qualified, that's a lot of people. Now, once again, the banks, they don't have the underwriters, the funders, the loan officers, the operational staff, the processors, the people just to answer the phones. They just not enough people and capacity to do it. And so with that, the banks are able to just go, hey, let's turn up the volume a little bit, bring the rates up, because again, the government might say, hey, we'll lend the bank to bank money lower, they'll lower that percentage, but the banks will then say, what can we pass on to the consumer? Well, they're not able to pass a ton of the savings on to the consumer because they don't have enough people to handle the business. Now, a couple other things in the notes here. You've also have this reserve requirement in the banks. The banks, with the Dodd-Frank Act, had to keep 10% of the money liquid. So I give the bank, I deposit $1,000 into the bank. They have to keep $100. They can't lend it out. They can't do anything. They could take the 900 and go make money somewhere else. Now that 10%'s been lifted because now they have the ability to use that money to then lend to another bank, give to a person that says, hey, I don't have a job for a couple weeks. I'm a server in a restaurant and they just shut down restaurants in my area. I need to go pull out some of my savings. The banks need to be able to do that. So they lifted that requirement. I mean, it's literally a state of emergency where the government's having to step in and say, hey, banks, we're going to lift some of these things we've done for you guys, these handcuffs, so to speak, and they were put in place for safety purposes. Now they're saying, hey, go ahead and use it. Now, a couple of the concerns in my industry is obviously the employees, right? If people get sick and can't work, then there's more burden put on everybody else, which is more stress on them, which then can further drive their immune system down, right? So it's keeping everybody healthy, but then those people that aren't working, again, that capacity issue that we have in the mortgage industry right now, everyone's got to stay happy and work healthy, happy, and working to sustain the volume that we have now. Now, do we see the bonds and the stock market changing? Well, hopefully over the next, call it 8 weeks or so, you're going to start seeing that healthiness stabilize and then grow. So that means more into the bond market, which will stabilize and keep the rates low. So it's not like rates are going to stay at 5 and 6% from these other banks. I mean, we're still in the 3s and 4s, just we were in the 2s and 3s a week and a half ago. So again, this will stabilize. Now, here's another one. The government has said that when all these refinances are closing, the proceeds of that money will then get infused back into the bond market. So that way they can sustain the stable rate environment. Now, it doesn't mean they're going to go down a bunch. It just means they will remain stable. We're not going to get that huge uptick. Now, look, we all know that the recession is coming and these inflationary concerns are real, and COVID-19 is only making it come faster. When will it come? No one knows. So the economists don't know when it's coming. So what we want to do is watch out, because when that does happen, rates have to go up. And we're looking 5.5 is like a normalcy. So now is the time, if possible, to take advantage of it, because they're not going to drop to 0, half, 1%. Once again, we saw high 2s, 3s. The 15 years are fluctuating in the 2s. The 30-year fix tied to the 30-year Treasury bond, and some are tied to the 10-year, are going, mid to low 3s. Now, last week, they started to jump up into the 4s again because, again, the banks have to throttle that volume. Man, that's really about it for now. So if you need anything, reply to this, let me know. I'm happy to help, happy to give you some of the guidance that I have. Stay in touch, watch the World Health Organization, watch the CDC announcements, listen to what they're saying about the quarantines, because the sooner we can contain and slow the movement of COVID-19, the faster the economy can come back. It's going to be a little while. It could be a long while. I don't know what this does for the housing market, for the mortgage business, but I did want to address the Fed lowering to 0%. Well, like I said, I hope everyone is safe. If you need anything, please reach out.